part 2 of Chapter 9. I want to focus today on cost allocation. We previously covered these topics, the basic transactions over the life of a long-term physical asset. In this lecture, one of the topics is going to look more narrowly at this cost allocation depreciation. So let's flip forward several pages till you get to this particular page, where it very narrowly defines depreciation, and we talked about it is allocating the original cost of the asset over its useful life, so the period benefited by the asset's use. So we acquire the asset, we're going to take at least part of that cost and allocate it to an expense. And we know assets, once we consume an asset, it does become an expense. And so in essence, that's what we're doing here. Now, in part 1 of this lecture that we've already had, we went through straight line depreciation. And if you recall, just back up just a little bit, just to pull the numbers together, we had an asset that cost $5,200, its original acquisition cost. We expect to be able to sell it at the end of its 4-year useful life. So we depreciated a total of $4,000 over 4 years, so $1,000 annually. So depreciation expense was $1,000 each year for 4 years. So if I plot that on this line over 4 years, if I can get this line to draw straight, that's what straight line depreciation is going to look like. So it's just going to be, I can make that work, a flat line. So anyhow, it's going to look something like this, a flat line. Now the other option are these accelerated methods. The theory behind the accelerated method is that we would get more benefit out of an asset early on in its useful life. So if we think that depreciation is allocating cost over the periods benefited, we get more production out of a machine. In this case, it was a copy machine early on in its asset's life. So in that case, we might have $2,600, and then maybe year 2, something like this, and then year 3 down here somewhere. And then, you know, our line's going to look something downward sloping like this. And that is called an accelerated method. Oops, misspelled that. So an accelerated method. So accelerate means we have more depreciation early on in the asset's life, but then it will decline. So double declining balance is one of many accelerated methods, and it's the one I'm going to demonstrate. So let's flip back to our depreciation schedules. Remember, at the very beginning, cost was $5,200. We wouldn't have depreciated anything yet. And then the book value would still also be $5,200, just like with straight line at the very beginning. Now, this is the formula for double declining balance. Your textbook does not actually require you to do the calculations except in an appendix, so we're not actually going to do that. I am just going to tell you in year 1, depreciation expense would be $2,600. In year 2, it will drop enormously to $1,300, and then year 3, $100, and then 0. And if I add those up, I will still get $4,000 total depreciation, just like we did with straight line. And again, we're not going to look at how to calculate it. We just know that there will be more expense earlier on, and then that'll drop off over the asset's life. So in this case, instead of $1,000 in year 1, the journal amount would be $2,600 here. So if we made a journal entry for $2,600, then the expense in year 1 is $2,600. If we go back, here's our accumulated depreciation account. Remember, it goes up with credits. It would be $2,600 for 2016. So this time, again, here we're assuming we did not do straight line, so ignore this account. This time, instead of straight line accumulated depreciation, we would have this declining balance account. And at the end of 2016, we would have cost in the copier account and $2,600 in the accumulated depreciation account. So let's put those here. We would have cost in the asset account itself, $2,600 accumulated. Remember, cost minus accumulated is our book value of $2,600. And all of this goes on the balance sheet, right? Those last three columns go on the balance sheet, whereas expenses go on the income statement. Then the second year, the end of 2017, the journal entry would be for $1,300. So I would have a $1,300 expense on the income statement. We would post the credit of $1,300 to accumulated. And so here at the end of 2017, the balance would be $3,900. So on the balance sheet, we have this account with $5,200 in it, the accumulated depreciation with $3,900. So $5,200 minus $3,900 gives us a book value of $1,300. Then a whole nother year goes by, and we only have $100 left to depreciate. We would put $100 into this journal entry. The expense of $100 goes on the income statement. We would post this credit to the accumulated depreciation account. So at the end of 2018, we would have a $4,000 balance, and we're done. So the copier account would have this. Accumulated would have a $4,000 balance. And we would not make any more journal entries. So now our book value is $1,200. And again, we wouldn't make any more, right? Zero. So those account balances will not change. They'll stay at $5,200 and $4,000. And salvage value will stay at $1,200. Nothing happens that fourth year. So just like we saw here at the very end, salvage value equals the of $1,200 is our book value. Remember, salvage value was $1,200. That's what we think we can salvage or sell the asset for. And we end up with that $1,200. Okay, so that would be the whole process of an accelerated depreciation method, and I use double declining balance to illustrate that. Okay, so we can see straight line versus an accelerated method. Now, what I did is I took from those depreciation schedules straight line versus double declining balance. Now, let me back up just a minute before we get into that. We have as an accountant, we report financial statements to our investors and creditors. We also have to fill out an income tax statement that goes to the IRS, right? So we have our public financial statements that go to investors and creditors. We have our tax return that goes to the IRS. Now, we saw different kinds of cost allocation with inventory: FIFO, Lifo, and weighted average. Now, when using those methods, tax law pretty much requires, if I use FIFO for tax, I also have to use it for financial statement purposes. So generally, we'll see if a company uses one of these methods for tax, you're going to see the same accounting cost allocation method used on the financial statements. So I might cost my cost of goods sold in ending inventory at FIFO on my financial statements. I'll use FIFO for the tax return. However, that is not the case over here with property, plant, and equipment, long-term physical assets. The accelerated depreciation method for tax purposes is called MACRS, Modified Accelerated Cost Recovery System, but it's an accelerated method. And that method is so accelerated, right? Here's double declining balance. If I did MACRS, it would probably look about like this. It would be that fast. Over 2 years, this asset would be depreciated instead of 3. So it's very fast, so fast that the Financial Accounting Standards Board doesn't allow it as an accelerated method for financial statement purposes. So we get into a company can use straight line for its book and accelerated this MACRS for tax. Or they can use an accelerated this double declining balance method for financial statements, and then a different accelerated method for taxes. or they could use straight line and straight line. Excuse me. So, generally what companies tend to do is use straight line for financial statements and this Maker's accelerated method for tax reporting. That means there are two records for depreciation expense. Now, there's nothing illegal, there's nothing unethical about this either. And it's only depreciation. We're not saying there's two whole different accounting systems. There's only two different records for depreciation and only depreciation. And tax law allows this. I can use an accelerated method for tax and a straight line method for financial statements. And so why would a company want to do that? So let's go over here and look at that. So what I did is, remember for straight line, we had $1,000 each year for depreciation, but for the accelerated method, I had $2,600, $13, and $1. So I also went ahead and just said, remember in both cases we end up with $1,200 of book value, but throughout the 4 years that book value differed until we get to the 4th year. And again, just real quick, I am just pulling those numbers from here. So these book values for straight line, these book values for an accelerated method. Okay, so for the balance sheet, that's what I have. The rest of this is the income statement. So I just made up, let's say, if we pulled out of net income, exclude depreciation and income taxes. So this is net income excluding those two expenses. So if I start with $3,000, subtract my depreciation expense of $1,000, I will have income before taxes of $2,000. Assume the tax rate, my corporate tax rate is 30%. I will pay, I'll have tax expense on that of $600. That minus that gives me net income. And then I just kept it the same for all 4 years. So if I add all of those up, 4-year totals, and the depreciation expense will total $4,000. That's what we will have accumulated by the end of 4 years. Now I did the same thing. I assumed $3,000 of profits, but I isolated depreciation and income taxes. Now what will happen is that I'll have different depreciation expense. So I take $3,000 minus $2,600. I only have income before taxes of $400. At a tax rate of 30%, I will only pay $120. And so then my net income is, 400 minus 120 is $280. So keep in mind the big picture here. Here's our external income statement, and here is our tax return that we are reporting to the IRS. Well, how do I record the journal entry for income tax expense then? Because in year 1, here's my expense of $600, so, there's my debit to income tax expense. But here's my credit to taxes paid, $120, and I have a difference of $480. And actually, I'm going to get away from journal entries. We won't actually do the journal entry. Just in case you're wondering, we would set this up as a liability, but I'm not going to have you do that. We're really just going to look in the short run, what are the cash savings? So what happens is we actually save $480 in year 1 by using this accelerated depreciation method for tax purposes. I only pay this amount, but on the income statement, I will show this expense. Let's go to the second year, when I have income tax expense of $600, but I will actually pay in the second year $510. Well, I still have $90 of cash savings. And let's accumulate these. So cumulative. So 480 and 90, we have accumulated cash savings of $570. And if you make that 570,000 or 570 million, you can see why this is advantageous for companies, because they save money on their taxes, at least in the short run. Now, let's take a peek back here. We're going to move into year 3. So in year 1 and 2, straight line exceeded accelerated, and we had cash savings then. Now we're moving into this area down below. And so we're going to see things flip-flop as we move into that area. So when we move into this arena, here's our expense again for year 3, but we're going to pay more than that. So we don't have savings, we actually end up paying more, 270. Cumulative of 570 minus 270, now my cumulative savings is only $300. And then the last year, my actual tax expense is $600. I'm going to pay $900. I actually, end up having a larger payment by $300. I had savings of $300, and this zeroes out. So it's only in the short run, right? This $570, make it thousands or millions. So in the short run, there is benefit of using 2 different depreciation methods. One for financial statements, one for tax purposes. So that gets into the really big picture between an accelerated method for income tax reporting versus using the straight line method for financial statement reporting, and why companies tend to do this very frequently. Okay, that really ends our discussion then of long-term physical assets. I want to move into another topic of another corporate asset that has a lot of value. And if I were to ask you, what's the single most valuable corporate asset in America, notice I said corporate asset, you might think of, like the Apple brand, or Coca-Cola's trademark. Because, especially Coca-Cola, I don't know that there's anywhere in the world, perhaps there is, but where Coca-Cola does not distribute their product. And Apple is recognized worldwide as well. So because those trademarks and brands are recognized worldwide, they have unlimited value. So the question is, how does an accountant report that? Well, the interesting thing is, for the most part, we don't recognize it. And so that is kind of an interesting accounting situation, because we know these assets have value, but it's hard for an accountant to actually come up with a dollar amount to report. So this kind of goes over intangible assets. They're non-current, they don't have a physical substance. Here's typical intangibles: trademarks, copyrights, patents, franchises, goodwill, etc. So let's go over the accounting rules. So here are the rules. Companies only record the cost of goodwill, software, trademarks, all of these intangibles if they buy these from the outside. So only if I pay money for them from an outsider do I actually record it. Because, we're going to give up cash, we got to record something. If it's internally developed, they're almost always expensed as research and development. So if it's internally developed, the debit, right, the credit is cash, the debit's either an expense or the debit is to some sort of intangible asset. So if I buy it from somebody else, I give up cash, which is a credit, and I debit some sort of intangible asset. If I spend money internally, usually that money is for research and development. Again, I give up cash with a credit, and the debit will be to R&D expense, research and development expense, which is a contradiction, isn't it? So if a company buys patent rights to Microsoft Windows, it can capitalize that cost as an asset. Capitalized costs as assets. However, if we hired a programmer to develop something internally, we would expense probably most of those costs. And we won't get into the great detail here. Sometimes these internal costs can get capitalized as asset, but most of the time they're expensed, and for our purposes we will just view, because the large majority are expensed, we'll look at expensing them. And the reason why we expense them is because at the time of research and development, we don't know with any certainty whether there will be any future economic benefit. right? And let's review real quick. Back to our front page, all the way back, right? When we have a cost, do we capitalize it as an asset or an expense? We will capitalize it if we know there's future economic benefit. But when we spend money on research and development, we don't usually know at that time that it's going to create future benefits. It might possibly create future benefits that we don't know for sure. So to be conservative, we just expense those costs. Okay, so then, if we do capitalize the cost of an asset as an intangible, we will, instead of depreciating them, we say we amortize those. And we use the straight line method. And then just a reminder, R&D costs are expensed. So I'll go over goodwill here in a little bit. Here's a little illustration. So here's a demo problem. On January 1, 2017, the company spends $18,600 cash to buy a patent that expires in 15 years. So they're buying it from an external source, so we capitalize that as an asset. And just to peek ahead, we can see, right, the patent is an intangible asset, so I debit it, and then cash will go out. So I capitalize that cost. The second one, though, the company spent $25,480 working on a new drug that will be submitted for FDA testing. This is internal, right? This is internal research and development cost, so we will expense that according to the rules. Because we do not know at this time whether it's going to get approved and it'll have long-term benefit. So in this case, we expense it, cash goes out. Recall expenses reduce earnings or retained earnings. So we debit R&D expense, credit our cash. Okay, and then lastly, we buy another business in 2017 for $650,000. Included in the purchase price is $75,000 of goodwill. Well, let's talk about that. Let's say in this purchase price, if I bought the company's assets separately, I would pay $575,000. So the net assets, I'll call it fair value, but fair value is really, if I bought them individually, what I would pay for them in the market. So if I had bought the assets, so net assets is assets minus liabilities. So I am taking on this other company's, right? If I buy another company, not only do I get their assets, but I also have to assume their liabilities. So if I bought all that individually, I really would pay this. So the question is then, why would you pay $650,000 for the total business? You know, why would a company do that? Well, there has to be, we've negotiated an additional $75,000 for something we're just going to label, because it's difficult to put our finger on it, we'll call it goodwill. But it's, some advantage this company has in the marketplace. The advantage could be, that it's got a great location, right? Maybe it's a gas station at a busy intersection. So because of location, they get lots of business. It could be the reputation of the company, loyal customer bases. But whatever it is, it really creates value for the business itself. So goodwill is something that creates value for the business because of some market advantage, location, reputation, that sort of thing. Okay, so when we record the purchase of this business, it's going to look like this. We would have the net assets. So, that's debiting all the various assets and crediting liabilities. We're just plugging it into this one account. But we would also create an intangible asset, goodwill, of $75,000. And, of course, cash will go out, which is an asset. So we'll have our net assets of the business coming in, and then we'll have goodwill separate as an intangible asset. Okay, so we've recorded, we capitalized that as well. So we have two assets, the patent and the goodwill that we capitalized before. And then we expensed research and development. Okay, so we've done number one. Number two, journalize the amortization. So just like we allocate costs for the physical assets via depreciation, we also will allocate costs for intangibles, but instead of depreciation, we call it amortization. So let's look at the rules for that. So intangible assets with limited lives are subject to rules by GAAP, and we would use straight line. So when we get over here, the patent has a limited life of 15 years. So if I take that 18,600, divide by 15 or take it times 1 out of 15 years, I'll get the annual amortization to be $1,240. So we will expense that. So instead of depreciation expense, we just call it amortization expense. Notice we do not have an accumulated patent account. We just decrease the asset directly. So we do not use accumulated. So there's no accumulated account. We just reduce the asset directly. So we've done the patent, R&D, it was expense, so there's nothing to amortize. Goodwill. Goodwill has an indefinite life. How long is that advantage going to be there? If it's location, it'll be there indefinitely. So because goodwill has an indefinite life, we do not amortize it over its use. We do not amortize it because it does not have a limited life. Okay, that's all those topics, and you're ready to do your homework in Wiley Plus.